This is Ilian Yotov welcoming you aboard. Happy Friday, everyone. Welcome to our weekly Outlook webinar. I'm a Forex strategist at allthingsforex.com, founder of the website, and also the host of the popular All Things Forex daily broadcast. I'd like to invite you to join me Monday through Friday for a live on a market analysis and listen to the All Things Forex program. Also, those of you interested in finding out about a new and revolutionary foreign currencies trading method that I created called the Quarters Theory, you're more than welcome to check out my book, The Quarters Theory. It is available everywhere books are sold. And I would also like to thank our friends at fx3.com for putting together the series of these webinars. It was really a pleasure to join you every Friday morning and give you the outlook, my outlook on the current events and also on the upcoming events. And speaking of, today we're going to prepare for the trading week, which is going to bring the spotlight on the euro and the British pound. Lots of important economic data, potentially crucial for the future fate of both currencies, the euro and the British pound, is scheduled for release throughout next week. Now, obviously, many of you have noticed in the current trading week that the risk was the main driver for the major currencies and for the financial markets. No surprise, of course, as we were preparing for the elections last Sunday from France and Greece. We saw, as expected, the change in the political landscape there. Lots of concerns that Greece may be one step closer to fail to form a parliament, to form a government, fail to comply with the requirements of the latest bailout austerity measures that were proposed, and ultimately one step closer to exiting the European Monetary Union. Today, a little bit of a hope and optimism that the Greek three winning parties after the election that have caused a fractional type of outcome from the election last Sunday might be able to put together a coalition. If they're not, the uncertainty levels are going to rise even further in the week ahead and in the weeks ahead as well, as the Greeks are going to prepare for another round of elections, potentially as early as next month in June. So that obviously risk is going to be a major factor. Besides of the top 10 spotlight events that I will give you in the next few minutes, the risk is going to be also the main driver of the currencies in the markets throughout next week. We're going to start the trading week with the first spotlight economic event. Right off the bat, the euro comes to the forefront on Monday morning with the Eurozone Industrial Production Report. Now, many of you know that this is a report that's a gauge of the output of factories, mines, and utilities. It gives some idea of what the industrial production levels were in Eurozone. And more than likely, the report is not going to be a very strong one. As it would not be shocking, of course, because economic data from the Eurozone has not been very positive. Recently, we've had very disappointing purchasing managers indexes, even lower than what the market was forecasting that they're going to see. Now, earlier this morning, we saw a report from Germany that showed the consumer price index, inflation pressures there are increasing a little bit. And later on next week, we're also going to see the inflation pressures in the Eurozone in its entirety. The industrial production is expected to show on Monday that it increased by 0.5% month over month, which is not necessarily that bad, but it would be lower than the 0.8% increase in the previous one. So this could be one of these weaker kind of economic reports from the Eurozone that might continue to weigh on the euro. Now, the reason I'm saying that is because we have seen the signs of weakness. We've known about the potential for the so-called mild recession, as Mario Draghi, the European Central Bank president, warned us about it in the fourth quarter of 2011 when he took the position as the new president of the European Central Bank. So it's not a surprise that the Eurozone is not doing well. And believe me, I'm trying very hard not to use the word recession here, because technically we cannot use that word until next Tuesday morning. And I will explain why in a few minutes, why we cannot yet use the word recession in the Eurozone until next Tuesday's GDP report is behind. But industrial production could be a reminder that conditions are not very positive economically in the Eurozone. We know that politically they certainly are not positive. And the European debt crisis concerns have made a big comeback along with the risk aversion. And investor sentiment has deteriorated throughout this week in the aftermath of the elections. Now, the European Central Bank has decided to sit on the sidelines last week, which was a little bit surprising. They were not as, to me at least, it was surprising because they were not as dovish as I expected them to be. It was sort of a wait-and-see type of a mode and a stance that the European Central Bank took, without opening the door or hinting that there might be further easing that they consider doing. However, despite of the fact that they decided to wait and see last Thursday, I still feel that there's pretty good chance that the European Central Bank will be forced, one way or another, to do something more as far as ease monetary policy. And I explained recently in recent programs what these three options that I'm expecting the European Central Bank to take are. The first one, of course, is more bond buying, which expands the European Central Bank's already inflated balance sheet. So hardly something that I would consider as a euro positive. The second option is LTRO number 3. After doing the long-term refinance operation rounds 1 and 2, the European Central Bank could be forced into doing another third round, especially considering the situation with Spanish banks. Even after round 1 and 2, Spanish banks continue to have problems with bad loans and so forth and so on. Spain, of course, is another country that's really in the forefront as the concerns about the debt crisis are increasing and anxiety levels are rising. And then the third, LTRO number 3 is not going to be euro positive either because it also expands the European Central Bank's balance sheet. And then the third option available for the European Central Bank is to cut interest rates. Now, some are saying, no, they're not going to do that. They're going to keep rates at the 1% level. I wouldn't be surprised if the European Central Bank actually cut rates. So I've been saying that since pretty much the fourth quarter of 2011. After the previous 2 interest rate cuts that the new president, Mario Draghi, had to do to undo the 2 hikes from Jean-Claude Trichet earlier in 2011. So I wouldn't be surprised if the European Central Bank cut rates as well. All of these 3 options are available, and neither one of these 3 options ahead for the European Central Bank I would consider as a euro positive. And so don't be surprised if the euro continues to stay under pressure if the economic data from the Eurozone continues to show signs of weakness, simply because it raises the odds that the European Central Bank might be forced into doing more and choosing one of these 3 options going forward, potentially as early as their next meeting in June. And I wouldn't be surprised if there's an interest rate cut on the horizon as well, simply because the political pressure, now that the political landscape is changing and the mood and the outlook is shifting from austerity, as we're seeing in France especially, voters there elected the first socialist president who is anti-austerity, more pro-government spending and more stimulating economic growth. Do not be surprised to see the pressure, political pressure, increasing on the European Central Bank to do more. We know that central banks are independent, but they're not immune from political pressure. And so this is something to watch for in the weeks and in the months ahead as well. So the Eurozone industrial production is expected to be weak report. And then the even more weak reports are going to come from the Eurozone more than likely next Tuesday. Now, the reason I said we cannot technically claim that the Eurozone is in a recession, it's pretty much what everyone, including myself, is expecting and anticipating. And I have been anticipating it for the last couple of quarters. But technically, we could not claim that the recession is there until this report on Tuesday at 5 a.m. Eastern Time, which will be the preliminary estimate for the Eurozone gross domestic product, the main measure of economic activity and growth, or the lack thereof, in the case of the Eurozone, simply because the consensus forecasts are expecting another consecutive quarter of contraction in the first quarter of 2012. following the 0.3% contraction in the Eurozone economy in the fourth quarter of 2011, the Eurozone is expected to contract again by at least 0.2%, but the less optimistic forecasts are expecting another 0.3% of a contraction. What does that mean? It means what I've been talking about for the last 2 quarters. It means 2 consecutive quarters of negative economic growth, which is the definition of a recession. Whether mild or not, it is a recession. And it's a double-dip recession. And it is another report there that could increase the odds that the European Central Bank, whether they want it or not, might be forced into doing more easing, which could elevate the pressures on the single currency, as well as the anxieties about the debt crisis they're spreading and so forth and so on. Also, at the same time as the GDP report from the Eurozone on Tuesday, at 5 a.m. Eastern Time, we're going to see the ZEW Institute and its survey. Based on a survey, they put together an index, so-called Economic Sentiment Index from ZEW. For Germany, the largest economy in the Eurozone, the index is expected to decline from 23.4, reading of 23.4, to 19.2. Doesn't look like a very good report, if the consensus forecasts, of course, are accurate. Then for the entire Eurozone, the Economic Sentiment Index is expected to show a reading of 11.7, which would be lower than 13.1. Now, given the conditions and the latest developments, and this is a sentiment index, I wouldn't be surprised if that index is even lower. And so this could be another negative economic report from the Eurozone coming up on Tuesday morning. Needless to say, these are all risk events that could continue to weigh on the single currency. Recently, we have witnessed, finally, this week, the euro breaking below the $1.30 level, which is, of course, an important level. The euro-dollar currency pair, by the way, very comfortably fluctuated. Euro-dollar exchange rate comfortably fluctuated within a clearly established range. It looked like things are getting back to normal at first, right? But I hope that those of you who listen to my webinars or my All Things Forex program regularly remember me using the words, the quiet before the storm. It was sort of a lull that the euro-dollar exchange rate was fluctuating within $1.30 and $1.35 pretty much for the last several months. It looked like things are going back to normal, everything is just rosy. Until after the elections, everyone realized that the worst is not yet behind for the single currency. There are so many issues still that have to be addressed. Is Greece going to be a member of the Eurozone, or are they going to exit? Is Spain going to also be forced into asking for a bailout, which the Spanish government, unfortunately, is not really doesn't seem to be as a very capable at this point to convince investors that they're not going to ask for a bailout. And this is, we know, if one thing that we learned from the last several years of this European debt crisis is that things can get ugly very fast. And I think last week is a very clear example of exactly that, how things could get ugly very, very fast. And you can see that significant decline for the euro in the 6 days or so of a straight sell-off, where the euro was put under pressure and it challenged the bottom of its existing range, broke below the $1.30 level, something that the euro did not do 3 times in a row in the last several months. The euro tested the $1.30 area. Neither one of those 3 times was it successful to produce a decisive breakout. And by decisive breakout, I mean a definite move and staying below $1.30, not just an overshoot by a few pips. In February, on February 16, the euro-dollar pair reached as low as $1.2973. I wouldn't call that a decisive breakout below $1.30. In the days after that, it immediately jumped above $1.30 and went to go to almost reach $1.35 level. Then on March the 15th, the euro-dollar pair tested $1.30 again, but stayed a few pips above it at $1.30.02. Most recently, few weeks ago, the euro-dollar pair once again tested the $1.30 level on April the 16th, reached as low as $1.2993. Hardly what I would classify as a decisive breakout. Is what I call a 7 pips of an overshoot, below the bottom of the existing range. This time, however, this week, things were different. This time, the euro broke below the $1.30 level. And I would like to bring to your attention some of the methodologies that I've created with my quarters theory. Nowhere else, no one else you're going to hear out there speaking about what I call the phenomenon of 1,000 pip range transitions, because that is exactly what the euro-dollar pair is attempting to do this week. It had attempts before, 3 of them, but neither one of them were successful. And things look, and we're in the very early stages. This is a little disclaimer here. We are in the very early stages of such attempt and for the euro-dollar exchange rate to transition into a new 1,000 pip range. But nevertheless, I find this to be a very, very important development in terms of my quarters theory methodology. So let me give you a background as to what I'm talking about here, because I bet there's a lot of you out there that are scratching your heads going, what in the world is this guy talking about? 1,000 pip range transitions. What is this? With my quarters theory, I look at prices, the most basic but also the most important information available to a trader. And I look in terms of price interest points. As currency traders, we have to consider currency exchange rates in terms of price interest points, or pips. When I look at the major whole numbers, such as $1.20, $1.30, and because of for further precision, of course, with currency exchange rates, decimal points are used to represent these exchange rates. So 1.20, 1.30, 1.40, 1.50, and so forth and so on. These are major whole numbers. I call them major whole numbers because they are important junctions between two 1,000 pip ranges. They mark the beginning and also at the same time the end of a previous 1,000 pip range and the beginning of another 1,000 pip range. For example, the $1.30 level with the euro-dollar exchange. It's an important junction. It's a hugely important number because it's the number that signifies the end of the $1.20s, or the 1,000 pip range between $1.20 and $1.30, and the beginning of a new 1,000 pip range between $1.30 and $1.40. Now, as the euro is falling below $1.30, it is obviously making an attempt to transition its exchange rate versus the US dollar into the 1,000 pip range below $1.30, and that would be the $1.20s, the 1,000 pip range between $1.20 and $1.30. And those of you who are still wondering how do you get the 1,000 pip range, you should know, as I bet you do, that between each and every two major whole numbers, there's an exact constant range that never ever changes of 10 cents for the euro-dollar exchange rate, or 10 yen for the dollar-yen exchange rate, so forth and so on, which these 10 cents, in terms of pips or price interest points, give you exactly 1,000 pips. Now, with my quarters theory, I divide these 1,000 pip ranges into 4 equal parts. And I derive 4 large quarters of 250 pips each, that each 1,000 pip range is composed of. And I challenge the notion of chaos and randomness. Many out there would claim that, oh, it's all random, it's a chaos. I say no to that notion. I challenge it with my quarters theory because I propose that instead of chaos and randomness, there's actually organization and systematic type of price moves that occur as exchange rates and prices in general fluctuate between the large quarter points of each 1,000 pip range. In other words, with my quarters theory, I propose that every significant price move occurs from one large quarter point targeting another large quarter point. Now, if I have to give you this most recent example with the euro-dollar exchange rate in the last several months, you're not going to see, if you're not familiar with my quarter series, you may not notice these type of fluctuations. It may seem just as a chaotic random type of fluctuations in the last several months for the euro-dollar exchange rate. But let me bring your attention to this. Let's take a look at which price level has been serving as the bottom of this existing range. Now, in neither one of the three attempts to challenge have we seen exactly the major large quarter point of the $1.30 registered as a high, low, open, or close in any one of these trading sessions. First, for example, on February the 16th, we had $29.73. Well, that's a number a little bit below the $1.30 level. Then we had a $1.30.02. That's a number a couple of pips above the $1.30 level. Then we had $29.93. That's another number that's not exactly $1.30, but it's within 7 pips from that major large quarter. It's practically impossible for $3 or even now $4 trillion per day volume type of a market for prices to stay exactly at a large quarter. As a matter of fact, in most instances, these large quarter points would seem disguised with what may seem as completely random numbers, $29.73 or $30.02 or $29.93. But we know, those of you at least who are familiar with my quarters theory, know what the important price level there is. That's the major large quarter point of the $1.30. And so I, in my quarters theory, talk about these 1,000 pip range transitions when a major large quarter point such as $1.30 is challenged, because they're crucial developments. They are not developments that the market just wakes up one morning and says, let's go ahead and target $1.30 and break it, and let's transition the euro-dollar exchange rate, for example, into $1.20 from the $1.30 just because. You have to always have a strong enough fundamental backdrop that justifies either the euro-dollar pair staying above $1.30 and the euro-dollar exchange rate in the $1.30 1,000 pip range, or the fundamental backdrop has to deteriorate significantly in order for the market to decide to reprice the euro-dollar exchange rate, and that the underlying fundamentals no longer justify a euro-dollar exchange rate into the $1.30s. And this is the importance of the 1,000 pip range transitions, because when the market decides that the current underlying fundamental backdrop no longer justifies a euro-dollar exchange rate into the $1.30s, then you can see these type of shifts occurring. You can see the market very quickly, in 6 days, pushing the euro-dollar exchange rate from the $1.30s, below $1.30, and into the $1.20. That's what's different this time around compared to the previous three attempts to break below $1.30. And this is why we're going to have to keep an eye on the developments in the weeks ahead and keep an eye on that economic data from both the Eurozone and from the United States in order to gauge whether or not this 1,000 pip range transition into the $1.20s will be successful. Because it could mean not only the euro challenging these previous support levels at the $1.2857, which is the support from December the 29th, or even the January support level at the $1.2622. A successful 1,000 pip range transition of the euro-dollar exchange rate into the $1.20s could mean even further advancement beyond these support levels to $1.25. The next large quarter point below $1.2250, or maybe even a completion of the entire 1,000 pip range towards the $1.20 level. Because on the first previous, the two legs that the lower that the euro-dollar pair had given us, we saw such 1,000 pip range transitions occurring. And if this, which I think it is, the break below $1.30, opens the door for perhaps another major leg lower for the euro versus the US dollar, the implications of that leg lower would also be a transition of the euro dollar exchange rate into the $1.20s and further advancements into the $1.20s 1,000 pip range. Just as the euro dollar pair transitioned on the most recent two significant legs lower. Here's the first one that started from when the euro was trading above $1.45 and moving below $1.40 into the $1.30s. It almost completed the entire 1,000 pip range of the $1.30s. It reached a support at $1.3144 in October of last year. Then on the price correction, which was a significant price correction, the euro went back above $1.40, encountered resistance ahead of the large quarter point of the $1.4250. I mean, you didn't really think that the high at the $1.4246 was a completely random number, did you? It's 4 pips below $1.4250, large quarter point. Then on the next leg lower, the euro once again moved below $1.40, transitioned its exchange rate back into the $1.30s, and it managed to complete the entire 1,000 pip range from $1.40 to $1.30. Of course, it's a bearish move, it's a bearish trend. So it's going to be completed from the top down. With the euro even making an attempt at that time by January of this year, moving as low as $1.2622, that was an attempt for the euro-dollar pair to transition its exchange rate into the $1.20s even. Now, this is the euro-dollar's recent attempt that's happening this week to transition back into the $1.20s. And if we were to witness another significant leg lower, which I am suspecting, we could see the euro-dollar pair. If this is another leg similar to this one, we could see another 1,000 pips potentially lower for the euro versus the dollar. Of course, this is not going to be a 1,000 pip move, or at least 500 pips move that happens overnight. It could. It's not that we haven't seen it. Can you say 2008? But the likelihood of this happening in a matter of overnight or in a couple of days is not very, very high. The latest leg lower saw the euro declining by about 1,600 pips, from the high at the $1.4246 to the low at the $1.2622. It's about 1,600 pips of a decline, and it happened in, 3 months or so? October, November, December, mid-January, so 3.5 months. So this could be the type of a leg lower that lasts maybe 3-4 months, that the euro-dollar pair exchange rate transitions into the $1.20s, makes further advancements into the $1.20s, challenges these support levels, $1.28.5 area, $1.2622, and if it were to break below, then that opens the door for further advancement to $1.25, $1.2250, or maybe even $1.20 in the months ahead. But again, it's all going to be dependent on whether or not the market prices in aggressively that the European debt crisis will escalate, that Greece is going to exit, which opens the door for other members of the Eurozone to exit the monetary union, maybe Portugal. Problems in Spain intensifying, Spain asking for a bailout, and the Fed refraining from the European Central Bank being forced to do more quantitative easing or any kind of other stimulus, cutting rates and so forth and so on. And also at the same time, the Fed refraining from doing more quantitative easing here in the United States. That would be the type of environment that gives you that significant leg lower for the euro versus the US dollar. And that is why we're going to watch that pullback of the euro-dollar exchange rate back to the $1.30 level. On that pullback, we do not want to see the euro climbing above $1.30 and starting to fluctuate comfortably again between $1.30 and $1.35. That would be a move back to the same old. At that point, the odds of the euro transitioning decisively into the $1.20s will decrease. But if the euro does not go back into its previous range, if it stays below $1.30, if it makes further advancements lower to $1.28.5, breaking below that level, would see the euro more than likely going to $1.2750 large quarter point, maybe even $1.2622. Those are the type of developments that if we get to see in the weeks ahead, could give us the first hints that this 1,000 pip range transition into the $1.20s may be successful going forward. Now, let's go ahead and move on with the important economic events. Throughout next week, not only we'll see events from the Eurozone, but also on Tuesday, we'll see the beginning of a sequence of important U.S. economic data. Tuesday, Wednesday, and Thursday, we'll see important U.S. economic reports. And with the Federal Reserve Chairman Ben Bernanke reminding us at their last press conference following the Fed's latest monetary policy decision, he reminded the markets that the option of more quantitative easing is quote, still very much on the table, Mr. Bernanke said. So do not count QE number 3 out just yet. It's a major factor that could continue to weigh on the U.S. dollar. And as I have said recently, each and every weak economic report from the United States is only going to raise the odds of the Fed doing more. No, there's no elections in Greece this Sunday. I'm sorry, I'm getting an email. There may be, though, new elections set in the next month or two, possibly as early as June. The elections in Greece were last Sunday, and they led to no clear winner. Three parties there are trying this whole week to form a coalition, and it doesn't look to me like they're succeeding to do that, which obviously increases the levels of anxiety and uncertainty. The U.S. economic data, as I was saying, each and every week economic report from the U.S. could weigh on the U.S. dollar going forward because it raises the odds of the Fed doing more quantitative easing. It was actually Goldman Sachs strategist or chief economist at Goldman Sachs that yesterday issued a note to their clients that Goldman Sachs is expecting the Fed to offer another round of quantitative easing, or the so-called QE number 3, at their meeting in June. That meeting is a two-day meeting on June 19 and June 20th, with the announcement coming on June 20th, Wednesday, June the 20th. And I'm jumping the gun a little bit here, going a month and 10 days ahead to prepare you for things, but please save the date, because in the weeks leading to that meeting by the Fed, each and every U.S. economic report is going to be very closely dissected by the markets for any signs of weakness. And if we end up seeing throughout the month of May what we witnessed throughout the month of April, which was a series of disappointing economic reports, weak economic reports from the U.S. To refresh your memories, we started April with a disappointing non-farm payrolls report. Then, throughout the month of April, we got to see 3 weeks of surprising spikes in the jobless claims. That led us to the lower GDP estimate for the first quarter, 2.2% instead of 2.6% that some forecasts were expecting. Now, I've been warning about the potential for a lower GDP growth in the United States pretty much for the last several months. And I quoted even Moody's month-over-month estimates that were the most pessimistic of the ones, expecting 1.8% GDP growth in the first quarter in the U.S., which is significantly lower than 3% level. I said it might not be that low to 1.8, but we could be lower than the 2.5, 2.6% that the consensus forecasts were expecting. And certainly we were. On top of that, following this sequence of weak economic data from the U.S. throughout the month of April, it seems like we started the month of May with another disappointing non-farm payrolls report. Now, I know to the forefront is all of the election jitters in the Eurozone and the European debt crisis concerns and so forth and so on. But let's not forget that last Friday's non-farm payrolls report was not a good one. And that's the second consecutive month of the U.S. labor market showing signs of weakness. As I have said previously, if this were to become a trend that lasts for at least a couple of months, April, May, and leading to the June 20th would be almost 3 months. If the U.S. economic data in this time frame, ahead of the June 20th announcement by the Fed, were to continue to show the signs of weakness that we witnessed in April, then that raises the odds of the Fed doing what Goldman Sachs is expecting on June the 20th, as early as June the 20th, exponentially. And that raises the pressure potentially on the U.S. dollar. Because another round of quantitative easing, the so-called QE number 3, is going to be good for equities and the stock markets, but it will be at the expense of the US dollar. And so do not be surprised if the dollar does not fully take advantage of the situation and the weakness in the euro going forward, especially if the U.S. economic data does not show resilience. Retail sales next week could be the first of the reports from the U.S. that could show signs of weakening or slowdown. Retail sales are expected to increase by 0.2% month over month compared with 0.8% in the previous month. On top of that, inflation, the overall consumer price index month over month, is expected to increase by 0.1% month over month, which is lower than a 0.3% in the previous month. Here's another factor there. If inflation is not an issue, if inflationary pressures are not rising, then that creates a more comfortable environment for the Fed to consider more quantitative easing. And so be aware of the potential for these reports to weigh on the greenback. Then that's going to lead us to a sequence of important economic data from the United Kingdom. Wednesday, I see as a very key type of a trading session for the future fate of the pound-dollar exchange rate. On Wednesday, we'll start with the United Kingdom jobless claims and unemployment rate, which, by the way, is going to be a potential risk event for the British pound strength. In a way that the claimant count change, which is the jobless claims, are expected to be to rise from the previous month when they were up by 3,600, and that measures the number of people who file claims for the first time for unemployment benefits. Previous month, we had 3,600 people claiming first-time unemployment benefits. The report next Wednesday's forecast is expecting almost 5,000. So more people claiming unemployment benefits is not a positive report. Unemployment rate is expected to stay unchanged at 8.3%. However, some forecasters are saying it might inch a little higher to 8.4%. It could weigh on the British pound if the employment report shows weakness in the United Kingdom's labor market. Then at 5 a.m., 30 minutes later, we'll see the main gauge of inflation from the Eurozone, which also is an important report because if inflation pressures are not rising, then that creates a comfortable environment for the European Central Bank to consider more easing, as I explained earlier. 30 minutes after that, another even more important event from the United Kingdom is going to come with the Bank of England's inflation report. This is the official assessment by the UK Central Bank on inflation and also economic output. And according to the latest forecasts, that report could open the door for the Bank of England to do more quantitative easing. It could give a signal to the markets that despite of the fact that yesterday the Bank of England decided to sit on the sidelines and not expand the size of its quantitative easing program, that if economic conditions were to deteriorate and if inflation is not a problem, if inflation pressures are subsiding, then the Bank of England may be forced into doing more quantitative easing. After all, the latest expansion of the Bank of England's so-called asset purchase program was called by some experts as a preemptive vote of no confidence in the European Union leaders' ability to contain the debt crisis. The latest increases happened in light of the debt crisis and concerns accelerating in the UK, which is the Eurozone is the largest trading partner of the United Kingdom's economy. So it's understandable for the UK to be concerned about conditions deteriorating politically and economically in the Eurozone. And it was the Bank of England's decision to do that preemptive increase in their size of their quantitative easing program in order to stimulate the UK economy further. To weather the impact of the slowdown and recession in the Eurozone, obviously not very successful because in the first quarter of 2011, the United Kingdom's economy contracted as well for a second consecutive quarter. But the inflation report, if inflation is not forecast next Wednesday by this inflation report to continue to rise and stay above target, then the Bank of England could feel that there may be further need to do more quantitative easing. Just this morning on Bloomberg, two large financial institution and forecasters there, analysts there, at Deutsche Bank and BNP Paribas, both of them expecting that the Bank of England is going to do more. I'm going to quote the Deutsche economist in London saying they will have no choice but to revise their growth projections, saying that they will revise their projections for economic outlook for the UK. And they have a dilemma, he said, of high inflation and very weak economic growth, but you definitely, he said, cannot rule more quantitative easing out. If that is what we see from the Bank of England's inflation report next Wednesday, then that's a major risk event for the British pound. And the BNP Paribas economist also said that the inflation report would present a fairly dovish assessment on the United Kingdom's economy. As I said, if that is the outcome of that inflation report from the Bank of England next Wednesday, it could weigh on the British pound significantly, and it could accelerate the pound's correction of its current gains. If you see here, especially during the last leg higher, the pound strengthened for 11 consecutive trading sessions without any significant price correction. Finally, that price correction started kicking in here in the last couple of weeks. It's a healthy, normal development, in my opinion. And according to my rough estimates, up to 50% correction of the previous leg higher, which produced 500 pips of gains for the pound versus the US dollar, up to 50% correction of that would be, let's say, 250 pips. I estimated that would fall from the highs at $1.63 that the pound reached recently to about $1.60.5 area. And that's exactly what we've seen here in the last few trading sessions. But it is that level of previous resistance at the $1.6061 that is being tested by the market in the last 3 days. And today we're overshooting a little bit below it by 1 pip with an intraday low at the $1.6060. This is going to be a key level to watch throughout next week. And very shortly below that, an even more important level to watch, the major large quarter point at the $1.60. Let's go back to the 1,000 pip range transitions, shall we? The pound-dollar pair breaking above $1.60 and also above the top of its multi-month range at the $1.6165, completing the first large quarter of the $1.60s between $1.60 and $1.6250, and gaining even more to reach as high as $1.63 is the first sign of a 1,000 pip range transition. Now we could see next week potentially the second sign. The second requirement that I created is that completing the first large quarter of a new 1,000 pip range is the first positive sign that the 1,000 pip range transition could be successful, but that is not enough. I have a second requirement that has to be met. On the pullback or retracement, as the one that we're witnessing with the pound-dollar pair, during which, of course, prices would retrace back to the major large quarter point of $1.60. Prices have to stay above the $1.60 level to show a sign of weakness, and to show a sign of strength, and to show us that this time around the 1,000 pip range transition is going to be successful. And I'm saying this time around because the first time around was in October of last year. You can see the pound breaking above $1.60, reaching that high to $1.6165. Did it complete the large quarter between $1.60 and $1.6250? No, it did not. Did it stay above $1.60 on the move lower? No, it did not. So in October, November of last year, the pound-dollar pair did not successfully transition its exchange rate into the $1.60s. It fell back into the $1.50s, and it started trading between $1.52.5 and $1.60 for a number of months. Now, however, we're seeing the pound finally breaking higher. We're seeing that pullback to $1.60. If it stays above $1.60, we could potentially see the first signs of a 1,000 pip range transition being successful. And if the market keeps the pound-dollar exchange rate into the $1.60, and the market prices in that the underlying fundamentals justify a pound-dollar exchange rate above $1.60, then what that means is that we may see further advancement of the pound-dollar exchange rate further into the $1.60, not only back to $1.6250 or $1.63, but also to the major half point at least of that new 1,000 pip range of the $1.60s. And that major half point is the half point between $1.60 and $1.70. That's the large quarter point at the $1.05. These would be the implications of a successful 1,000 pip range transition, and these two requirements being met. And as early as next week, we could see the test of the major large quarter point of the $1.60, and we'll have to gauge how the British pound behaves at that level in order to give us the clues as to the next significant price move, whether it will be back into the previous range between $1.60 and $1.52.5, or staying in a new 1,000 pip range, staying into the $1.60s, challenging the recent highs at the $1.63, which, by the way, is the high for 2012, the new high for 2012 for the year. And ultimately, if it breaks above that level, $1.65 could be shortly challenged after that. But be aware of the potential for the risk event next Wednesday, the Bank of England Inflation Report especially, that could intensify the pressures on the pound. It could lead to a test and possibly even a break below $1.60. If it paints a really terrible picture of the economy and opens the door for the Bank of England to expand the size of its asset purchase program. The sequence of U.S. economic data will continue next week with the housing starts and building permits on Wednesday. Probably a mixed bag of data, by the way. Housing starts are expected to increase a little bit, building permits to decline a little bit. Big risk event for the dollar next Wednesday could be the Fed FOMC meeting minutes, which is the minutes from the latest monetary policy meeting by the Fed, after which Ben Bernanke said that quantitative easing is still very much on the table. So if that is what the meeting minutes show us, negative outlook on economic conditions in the U.S., further commitment to maintain the accommodative monetary policy, including considering further quantitative easing, the market could start repricing very aggressively expectations of what Goldman Sachs warned about yesterday, and that is that there may be QE number 3 coming up and announced as early as June the 20th. So it could be an event that weighs on the U.S. dollar if it contains any hints that QE number 3 is coming up sooner rather than later. And also on Wednesday night, an important report from Japan, which I think would be important to watch, is the estimate for the first quarter economic growth in Japan. And I'm using the word growth because we haven't been able to use the word growth in the previous couple of quarters. The Japanese economy registered its third recession in just the last decade. But the consensus forecasts are expecting that the Japanese economy is going to return back to growth in the first quarter of 2012, growing by 0.9%, compared with the contraction of minus 0.2% in the previous quarter. That is the type of report that comes out on Wednesday showing that Japan's returning back to growth. That could serve as a supportive fundamental event for the Japanese yen, which, by the way, has renewed its strength throughout this week as market jitters and anxiety levels rose and caused more risk aversion. The Japanese yen tends to benefit in periods of risk aversion. And then the final top 10 event for next week is going to be the jobless claims. As I mentioned earlier, we do not want to see what we saw in April. 3 weeks of surprising spikes in jobless claims. For next Thursday, the report is expected to show a little bit of an increase in amount of jobless claims from 367,000 to 375,000 is the number expected. If it's worse than expected, if we get to see a spike in jobless claims, that would be another economic report that weighs on the dollar because it shows signs of deteriorating labor market conditions, and ultimately that could force the Fed into considering to do more. Risk and QE number 3 expectations will remain the drivers going forward for the major currencies. Before we finish the program today, I'd like to invite you to listen to my All Things Forex live daily broadcast. It is live Monday through Friday, but also the archives. Each and every broadcast is archived, and the MP3 files of the archives are available on allthingsforex.com. You can register for free as a member of allthingsforex.com. You can access the files. You can listen to the broadcasts at any time, whenever you like, whenever it's convenient for you. Make sure to also follow us on Twitter. @allthingsforex is the Twitter account, @allthingsforex. I'd like to thank our friends at fxstreet.com for putting together these series of webinars, and I'd like to thank you for attending the webinar today. Thank you very much. Have a great day and a great weekend, and I will see you again next Friday at 10 a.m. Eastern Time.